Welcome to the Selftax YouTube channel. If you're an expat, business owner, or landlord, this channel is for you. We simplify tax rules, deadlines, and updates so you can stay compliant without the stress. Subscribe and stay informed. If you are a landlord with a mortgage on a residential property, Section 24 is one of the most important tax rules you need to understand. Since April 2020 it has been fully in force, and it affects every individual landlord with mortgage finance on a residential letting. In this video I am going to explain exactly what Section 24 does, how it changes your tax calculation, who it hits hardest, and what options are available to manage the impact. Before Section 24 came into full effect, landlords could deduct mortgage interest directly from rental income before calculating their tax bill. So if you received £15,000 in rent and paid £6,000 in mortgage interest, you paid tax on £9,000. That changed completely when Section 24 of the Finance Act 2015 was phased in between April 2017 and April 2020. Since April 2020, individual landlords can no longer deduct mortgage interest from rental income as an expense. Instead, you pay tax on your full rental income. Instead, you calculate your taxable property profits without deducting finance costs, and then receive a basic rate tax reduction equal to 20% of your qualifying finance costs. That is a fundamental change in how the tax calculation works. The 20% basic rate tax credit works as follows. You calculate your rental profit without deducting any finance costs. You pay income tax on that full profit at your marginal rate. You then reduce your tax bill by 20% of your total finance costs. So if your mortgage interest for the year is £6,000, your tax credit is £1,200, which reduces your final tax bill. For a basic rate taxpayer paying 20% tax, the credit broadly covers the tax on the mortgage interest portion, so the impact is minimal. For a higher rate taxpayer paying 40%, the credit only covers half the tax that applies to the same amount, which is where the real cost emerges. Take a basic rate taxpayer with £15,000 rental income and £6,000 mortgage interest. Under the old system, £15,000 minus £6,000 equals £9,000 taxable profit. Tax at 20% equals £1,800. Under Section 24, tax on £15,000 at 20% equals £3,000. Tax credit of 20% of £6,000 equals £1,200. Final tax bill equals £1,800. For a basic rate taxpayer the outcome is broadly the same, assuming the rental profit keeps them within the basic rate band. The impact becomes significant only when rental income pushes total income into the higher rate band. Now take a higher rate taxpayer with the same figures. £15,000 rental income and £6,000 mortgage interest. Under the old system, £15,000 minus £6,000 equals £9,000 taxable profit. Tax at 40% equals £3,600. Under Section 24, tax on £15,000 at 40% equals £6,000. Tax credit of 20% of £6,000 equals £1,200. Final tax bill equals £4,800. That is £1,200 more tax on the same property with the same mortgage, purely because of the way Section 24 changes the calculation. Higher rate taxpayers are where the impact of Section 24 is felt most directly. One effect of Section 24 that catches landlords out is that it can push you into the higher rate tax band even when your actual rental profit has not changed. Under the old system, mortgage interest reduced your taxable income. Under Section 24, your taxable property profits are calculated without deducting finance costs, which can increase the amount of income that falls into higher tax bands. So a landlord with employment income close to the £50,270 higher rate threshold may find that their rental income, counted in full, tips them into the 40% band. That means they pay higher rate tax on some or all of their rental income, while only receiving a 20% credit on their mortgage interest. The 20% tax credit applies to finance costs, not just mortgage interest. HMRC defines qualifying finance costs as mortgage interest, interest on loans used to purchase or improve the property, overdraft interest connected to the letting, and fees for arranging or renewing a mortgage or loan. Some mortgage arrangement or finance fees may qualify as revenue expenses, while others may be treated as capital costs depending on the circumstances and the purpose of the borrowing. The capital repayment portion of your mortgage never qualifies. Only the interest element counts. Section 24 applies to individual landlords with residential property. It does not apply to limited companies. A company that owns residential property can still deduct mortgage interest in full as a business expense against rental profit before paying corporation tax. It does not apply to commercial property. Section 24 is specific to residential lettings. And since April 2025, it applies to furnished holiday lets. The furnished holiday lettings regime was abolished from the 6th of April, 2025, meaning former holiday let properties are now treated as standard residential lettings and Section 24 applies to them from that point. There are legitimate ways to manage the impact of Section 24, though each has its own considerations. One option may be transferring beneficial ownership to a spouse or civil partner who pays tax at the basic rate, where appropriate. Depending on the ownership structure and your circumstances, this may reduce the impact of Section 24. A Form 17 must be filed with HMRC to formalize the split for tax purposes. The second option is incorporating, moving the property into a limited company structure. Companies are not subject to Section 24 and can still deduct mortgage interest fully. However, incorporation involves stamp duty, land tax on the transfer value, and potential capital gains tax, so professional advice is essential before proceeding. The third option is reducing the mortgage balance, which reduces the finance costs and therefore the Section 24 impact proportionally. Under MTD for income tax, mortgage interest must be recorded separately in your digital records as a finance cost, not grouped with other expenses. When you submit your quarterly update, finance costs appear in their own category. The basic rate tax reduction is taken into account when your end-of-year tax position is finalized rather than in the quarterly updates, not during the quarterly updates. This means your quarterly updates will show your full rental income and all allowable expenses excluding finance costs, and the credit adjustment happens when you complete your final declaration at the end of the year. Getting the categories right in your software from the start ensures your final declaration accurately reflects your Section 24 position. So what does Section 24 mean for your tax bill as a landlord in 2026? Individual landlords with residential property can no longer deduct mortgage interest from rental income. Instead, you receive a 20% basic rate tax credit on your total finance costs. For basic rate taxpayers, the impact is broadly neutral. For higher rate taxpayers, the additional tax cost is significant and can push total income into a higher band. The credit applies to mortgage interest, loan interest, and other qualifying finance costs. Not to capital repayments. Limited companies are not affected. Former furnished holiday lets are now caught from April 2025. Under MTD, finance costs are recorded separately and the credit is applied at the final declaration stage. If Section 24 is significantly affecting your tax position, speaking to a qualified tax advisor about your options is a worthwhile step. Next up, capital gains tax on property in 2026, what landlords need to know before they sell. Thanks for watching. Subscribe to Selftax for clear, practical UK tax guidance. Stay informed, stay compliant, and stay one step ahead of HMRC.